The recent market crash has brought so much to light concerning Wall Street's involvement in cryptocurrencies. Many have speculated that Terra Luna's crash was a coordinated attack by Wall Street to bring down cryptocurrencies, since the sector has been a major threat to the businesses. Do these speculations, however, hold ground? Why would Wall Street want to kill cryptocurrencies? In an annual report that was released by JP Morgan recently, the company admitted that cryptocurrencies such as Bitcoin and Ethereum might possibly compete with the bank's own services and steal money away from the banks. According to a recent publication, the bank has been forced to adapt to new technologies in order to maintain the loyalty of its customers. The report stressed the susceptibility of payment processing and other money transfer services to emerging technologies such as cryptocurrencies, which do not require middlemen. Since 2018, authorities around the world have voiced their fear that the growing connections between Wall Street corporations and cryptocurrency exchanges may threaten financial stability and lead to a financial crisis. According to the Financial Stability Board, large financial institutions such as banks and hedge funds, as well as other types of institutional investors, were warned to keep a careful check on the cryptocurrency market. The Financial Stability Board, FSB, claimed in a document that was published recently that crypto assets might potentially have a detrimental effect on the global financial stability if the present trend of increasing in scale and connectedness to these institutions continues. In March of this year, Morgan Stanley became the first of the 6 top U.S. banks to make a public announcement on its plans to give its wealth management customers access to Bitcoin funds. But was this involvement out of goodwill or a ploy to destroy investors' trust in cryptocurrencies? Everyone wants to believe that Wall Street is just another excited investor, ready to pump money into the burgeoning crypto market and enjoy comparable returns to retail traders every time the value of Bitcoin has skyrocketed. Because for one thing, Wall Street is already knee-deep in the cryptocurrency market. There have been many different ways for institutional investors to make money in the crypto market. However, as cryptocurrency's popularity continues to rise, the business surrounding it is transitioning into something entirely new. It's possible that Wall Street is trying to eradicate cryptos one coin at a time, either deliberately or inadvertently. Why can Wall Street kill cryptocurrencies? Let's start with hypothecation, the process of transferring ownership of a company's equity shares to a lender as collateral. To illustrate this point, let's imagine that a company like Tesla is trying to raise $400 million, but it does not want the money to be directly tied to it to hide its financial difficulties. In traditional finance, doing this is very difficult for a variety of different reasons. So, it is forced to go public, and in order to obtain the funds, a company like Morgan Stanley makes a commitment to provide Tesla with assets that are valued at $400 million in return for the funds. However, when it comes to cryptocurrencies, this is as simple as a walk in the park. In spite of the fact that many of the largest cryptocurrencies make the claim that they are founded on a system of proof of work or proof of stake, the actual trading of these cryptocurrencies takes place on centralized exchanges. Who can trace Bitcoin if it has been hypothecated 6 times to the brokers and exchanges that trade debt and collateral? Because the collateral chain is currently so wide, it is not possible to determine who actually owns the Bitcoin. This makes it impossible for banks to do business. In the case that many borrowers resort to cryptocurrencies, the consequences might be quite severe. Up until very recently, the only way to acquire cryptos was by using traditional currencies. As a direct consequence of this, users were only able to buy or sell cryptos. They were unable to short the cryptocurrency or exchange in derivatives trading. Every transaction was completed using Bitcoin, and anyone who bought a coin effectively withdrew it from circulation and took it off the market. Due to Bitcoin's limited supply and deflationary nature, its price increased drastically. This was caused by an increase in number of people purchasing Bitcoin and a decrease in the number of people selling Bitcoin, since buyers expected higher rewards the longer they held on. The fact that the market was instantly susceptible to the dynamics of supply and demand contributed, as one would expect, to the market's volatility. The price of Bitcoin has significantly dropped as a result of Wall Street's decision to provide Bitcoin futures contracts to its own brokers and exchanges in order to reduce the currency's volatility. The fluctuation in the price of Bitcoin is becoming more obvious as time goes on. The utilization of high-frequency trading bots has resulted in a further dampening of the volatility that is associated with cryptocurrency markets. Even in the environments with huge volatility, highly automated trading strategies, such as those utilized on Wall Street, have the potential to generate enormous profits. Without its high degree of volatility, the commodity would have no intrinsic or distinctive worth. Nonetheless, this high level of volatility is one of the main reasons for Bitcoin's appeal among traders, as well as its profitability. For crypto enthusiasts, a Bitcoin exchange traded fund, ETF, is the real-life equivalent of a pipe dream due to the fact that ETFs are settled in an underlying asset and are incorporated into the conventional financial markets via brokers. Investors who do not have the time or resources to buy Bitcoin on cryptocurrency exchanges or to maintain a blockchain wallet might find it easier to have access to Bitcoin through the use of an exchange-traded fund. October 2021 marked the beginning of trading on the New York Stock Exchange for Bitcoin ETFs, offering cause for hope to those who believe in the value of Bitcoin. This exchange-traded fund, or ETF, which is not directly tied to the price of Bitcoin, is monitored by the Bitcoin futures contracts traded on the Chicago Mercantile Exchange, or the CME. In contrast, the SEC has either rejected the ETFs of some companies that are closely tied to Bitcoin or have not yet authorized them. It is possible to earn money trading cryptocurrencies, but there are many unknowns regarding the manner in which Wall Street and other financial institutions will embrace it. Greg Bowdle, who is the head of U.S. stocks and derivative strategy at BNP, stated that the movements in the Bitcoin market coincide with retail money flooding into U.S. shares and equities options. When the great Bitcoin crash of 2022 occurred, Wall Street emerged victorious. This is in part due to regulatory constraints that were implemented in the wake of the financial crisis in 2008 and were put into place as a response. Because of the inherent risks, institutional money managers have developed convoluted strategies to limit their direct exposure to cryptocurrency markets. As a direct consequence of this, they were able to cut their losses during the crash of the market. According to Rina Agarwal, a finance professor at Georgetown University and the president of the Center for Financial Markets and Policy, many institutions have experimented with investing in cryptocurrencies, but this only represents a small fraction of their overall portfolios. The recent turbulence seen in financial markets was mainly connected to the precipitous drop in the prices of digital assets and the difficulties experienced by crypto startups. Even if the collapse of the cryptocurrency market is only a footnote on Wall Street, it has been a distressing experience for a great number of individual investors who had their money invested there. The prospect of high returns in a business that is not subject to the oversight of the monetary system led an increasing number of average investors to purchase digital currencies. These investors made judgments about their investments that were not necessarily based on solid judgment as a result of social pressure and internet forums such as Reddit. The chaos that ensued contributed to the quick expansion of the Bitcoin market. The value of the digital asset market reached an all-time high of $3 trillion. First, in the month of May, the value of Terra USD, a currency that should have been pegged to the dollar, but instead was algorithmically related to Luna, began to decrease. As a direct result of the downward spiral experienced by both currencies, the market for digital assets was thrown into complete disarray. The price of one Bitcoin dropped all the way down to $19,000 on June 18th, after having reached as high as $47,000 back in March. The fortunes of a great number of smaller investors started to fall as well. The Basel Committee on Banking Supervision, which is responsible for establishing the minimum capital requirements for large banks all over the globe, has assigned the highest risk score possible to digital currencies such as Bitcoin and Ether. As a consequence of this, officials from the Federal Reserve have issued a warning to financial institutions in the United States to steer clear of any activities that may lead to the inclusion of cryptocurrencies in their financial statements. Bitcoin and other digital tokens could not be used as collateral for loans. Banks could not guarantee the liquidity of a particular market, and banks could not provide prime brokerage services. As a direct result of this, financial institutions have begun offering their clients a limited selection of items associated with cryptocurrencies as a means of easing their transition into this new world without risking legal repercussions. What do you think? Could the involvement of Wall Street in cryptocurrencies be a threat to the sector? That's all from this video. See you in the next one.